Okay, guys, this is a chart that we put up on the blog on the 25th, and this is a monthly chart of the S&P 500. And you can see that this week we closed at the highs, just under or very near the highs, the underbelly of this trend line. And this trend line was broken back in August, and then obviously we stayed below it in September. And then in October, the lows of October 3rd and 4th, we just took out the lows that we put in 2 months previous in August. This rounded top, along with these 3 months, looks very similar to what we saw back at the all-time highs in the market in 2007, meaning the S&P, where we came down to this low here in January of 08. The low was 1270. The next month we were above it, very similar to where we were here in September. And then just by a little bit, couple ticks here and there, we took out those lows 2 months later. Very similar to what we did 2 months later here, which is this month, October, where we came down again October 3rd, October 4th, and printed basically, what do we finish that day? We actually, the low was 1074 for the month. So 1080 basically held on a close. So we want to be aware of this, where basically for us right now, even though the overall trend is long, it's been long since the 10th of the month, the way we see it, we would certainly want to hold 1200. At this time, the 50-day moving average, if we were to look on a daily chart, is just below 1200. We would sit up on our seat if we broke 1228. But anyway, this is a concern right now. The overall trend is long, but we don't want to just aimlessly, load the wagon and don't worry about putting stops in. Nobody knows where this is going to go. We could be in a new bull market, or this could look very similar to what we've got going here, where long term on a monthly chart we're almost putting in a triple top, going back to 2001, and then here, and then here. So we'll see. Let's take a look at a daily chart of the SPY. I've actually done one of these videos already today, but for some reason it wouldn't upload properly onto the blog. So this is video number 2. This is a post that went out to the 4-minute traders. We do think that we're going to come back down. We're a little overbought here, but the overall direction of the market looks good. I mean, there's a lot of force behind this buying. Today was a lackluster day, obviously. When we look at our position in the managed accounts of VTI, Vanguard Total Market Index, we did put in a limit order yesterday after the close to sell some with a print of 66.37. We were hoping we would get a move up today, intraday, and then just close either flat or lower. We never got that move to take out the highs of yesterday. We do believe we're going to come back down in high probability and fill this gap. I will decide over the weekend if we are going to continue to keep on that limit order to sell some at 66.37. If we would have popped up today, I would have been happy to get that fill, because then I think soon, next couple days, next week, we'd come back down and fill this. But we'll see. I'll make that decision over the weekend. When we look at the S&P cash again, even though this fourth wave here, we had a target for the fifth wave of 1050 to 1000. We never got there. The low that day on the 4th was 1074. This was a key reversal day. Not necessarily capitulation, but capitulation doesn't always have to happen at a low. Sometimes it can happen every couple years. It doesn't have to happen every quarter or so if there is a low. But in any event, my point is here, even though we thought 1050 or 1000 on the S&P, we did not wait. Conversely, to the upside, we're thinking maybe now somewhere between 1250, 1300. Obviously, we're above 1250, maybe even 1310. What we don't want to do is wait for 1310 to print, thinking we're going to take profit at 1310, or the equivalent of 1310 on the Vanguard Total Market Index. So what I'm getting at is if this was to go up maybe 1290, 1295, and then start to roll over and break through, let's say 1228, even 1240, we would start to either hedge or to take profit. Because even though in our mind we think 1310, 1307 is the number, if it never gets there, we're not going to wait for it to get there. No differently than we're not going to wait for this to get to 1050 or 1000. It stopped falling. There was a key reversal. You have to recognize that, especially once we got above the 50-day moving average in a downward sloping trend line. All right, so that's it for the S&P, but I thought looking at it long term, making the comparison, the potential comparison, and the outcome, looking back at that rounded top to 2007 is worth mentioning. And also still trading under the trend line on a monthly chart. Let's take a look at gold. We did fill this gap. We also removed our hedge because we were in this channel here. We thought possibly we could come back down to 150. It still may happen, but when we broke out the morning this Tuesday, we released the GLL hedge against GLD. We have filled this gap. If we get above the 50-day moving average and we fill this gap here, we will have a limit order to sell 50% of the balance on our GLD position, provided we do get to that level. And then we would move up our stop accordingly on the balance. And let's finish up. Maybe we'll take a look at bonds here. TLT. We talked about this being a head fake last week, sucking in the long bond buyers one more time, especially on the long end here, meaning the 20-year, 30-year. There's obviously been a sell-off here due to the strength in equities. But like I said yesterday on a still chart, if we were to fill, or if we were to come back down and test 108 or print 108 before filling this gap, we would put on a trade in bonds. All right, you guys, that's it. Doug McKay, antiwallstreetguy.com. The trend is long in equities since the 10th of October 2011. We'll see you next week. Thanks.